Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shenzhen Hepalink Pharmaceutical Group Co. Limited Annual Report. Shenzhen Hepalink Pharmaceutical Group Co. Limited offers a diverse range of businesses and services across various segments. The company operates in four main areas: finished dose pharmaceutical products, active pharmaceutical ingredients, API, contract development and manufacturing organization, CDMO, and others. In the finished dose pharmaceutical products segment, Shenzhen Hepalink provides a variety of medications, including Prolongin, Inhixa, Neoporin, heparin, and enoxaparin sodium injections. The company also offers API products, such as heparin and enoxaparin sodium APIs, as well as pancreatin API. In addition to its pharmaceutical product offerings, Shenzhen Hepalink provides CDMO services, which include research and development, manufacturing, quality management, program management, and technical support services for molecule biologics. The company is also involved in the development of several new drugs, including apabitalone, RVX-208, orgavamab, tositoxumab, R-301, R20.5, R-101, and H1710. Furthermore, Shenzhen Hepalink engages in various other activities, such as property management, investment management and consulting, biopharmaceutical technology development and consulting, equity and venture investment, provision of services on pharmaceutical-related activities, and trading of medical and biopharmaceutical products. Shenzhen Hepalink Pharmaceutical Group Co., Limited, market capitalization of $17 billion, is significantly larger than the average industry peer of roughly $2 billion. This shows that Shenzhen Hepalink Pharmaceutical Group Co., Limited, holds a significant advantage in their industry. Shenzhen Hepalink Pharmaceutical Group Co., Limited, trades at a higher price-to-earnings ratio of 19 times and a lower price-to-book ratio of 0.53 times relative within the industry. This suggests a potential market detachment, as Shenzhen Hepalink Pharmaceutical Group Co., Limited, trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company maintains a moderate leverage profile, with liabilities making up 30% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.38%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On one hand, the finished dose pharmaceutical products business has been a significant driver of revenue growth, with year-on-year increases ranging from 17.2% to 23.4%. This growth is attributed to the company's consolidation of its leading position in the European market and strategic collaborations with core sales channels. The CDMO, contract development and manufacturing organization business has also contributed to revenue growth, albeit slightly, due to effective project management and a broadening product and services offering by Cytovance. On the other hand, the API, active pharmaceutical ingredient, business has been a major driver of revenue decline, with a 26.5% decrease in revenue attributed to low export prices for heparin APIs and intensifying industry competition. Other drivers of revenue growth include double-digit growth in global sales for finished dose pharmaceutical products and expansion of market coverage and sales volumes in the Chinese market. Conversely, uncertainty, supply chain restructuring, and geopolitical disruptions have driven up business costs, contributing to revenue decline. Additionally, CDMO services revenue decreased by 39%, further exacerbating the decline. The net income of the company experienced a significant decline, decreasing by approximately $197.2 million and 46% year-on-year. This decrease was attributed to industry competition, compressing overall profit margins. The gross profit margin also saw a decline from 33.1% to 30.8%, with the API business experiencing a substantial drop in its gross profit margin from 38.6% to 24.8%. In contrast, the CDMO business witnessed an increase in its gross profit margin by 1.2 percentage points compared to last year. The decrease in net income and profit margins can be attributed to the intense competition within the industry, which has led to a compression of overall profit margins. The API business was particularly affected, with its gross profit margin experiencing a significant decline. However, the CDMO business managed to maintain relatively stable profit margins, even increasing by 1.2 percentage points compared to last year. The net income decrease from RM 421.8 million to RM 188.5 million further emphasizes the impact of industry competition on the company's financial performance. The decline in gross profit margin and net income highlights the need for the company to adapt to the changing market conditions and explore strategies to improve its profitability. The company's financial performance indicates a healthy trend. According to the provided summary, the net operating cash flow for the company stands at RMB 29,473. This significant amount signifies that the company is generating substantial positive operating cash flow. The figure suggests that the company's operations are profitable and capable of producing sufficient cash to meet its obligations. The company's debt level has undergone significant changes over time. According to the extracted summaries, total liabilities have decreased by RMB 589.8 million from RMB 5,141.4 million to RMB 4,551.6 million, representing a substantial reduction of 11.4%. Furthermore, total financial indebtedness has also decreased by 16.1% from RMB 3,544,801 to RMB 12,973,531. In terms of interest expenses, the company has experienced a notable decline. Finance costs have decreased by approximately RMB 70.5 million to RMB 74.7 million, representing a significant drop of 48.5%. Additionally, interest expenses on bank borrowings have decreased from 129,878 RMB 0 to 68,343 RMB 0. The decrease in interest-bearing debt and borrowing interest rates has also contributed to the decline in finance costs. Overall, the company's debt level and interest expenses have undergone significant changes, with a notable reduction in both total liabilities and interest expenses. The company's performance can be analyzed through its various segments and regions. In terms of segments, the heparin supply chain business and finished dose pharmaceutical segment stood out as performing well. The heparin supply chain business was a notable success, while the finished dose pharmaceutical segment also showed strong results on pages 23, 24, and 26. Looking at the regional performance, Europe emerged as a strong market, along with non-European and non-American overseas markets. These regions demonstrated impressive growth and success for the company. Overall, these segments and regions played a significant role in driving the company's overall performance. Management's outlook on the company's future is cautiously optimistic. They acknowledge that global economic growth is being hindered by trade conditions, emphasizing the need to address protectionism and policy uncertainties. To mitigate this, they plan to invest in innovative drugs and prioritize employee development. In terms of specific strategies, management is committed to advancing several key projects. These include exploring options for orgavamab's development, conducting a second-phase III study for RMINUS-301, implementing an accelerated development strategy for RVX-208, and progressing drug development for apabitalone. By prioritizing these initiatives, the company aims to drive growth and stay competitive in the market. Overall, management's focus on innovation, employee development, and strategic investment positions the company for long-term success despite current economic challenges. There is no significant activity to report on acquisitions and divestitures. The company has not engaged in any major transactions involving the purchase of other companies or assets, nor has it sold off any significant portions of its business. In fact, according to the information provided, there are no acquisitions or divestitures to note at all. This suggests that the company is focused on maintaining its current operations and investments, rather than expanding through external means or shedding non-core assets. Concerns about inventory buildup and supply chain disruption are emerging in various sectors. Inventory buildup is a pressing issue, as indicated by a yes response under the section for inventory buildup on page 16. This suggests that companies may be struggling with excess stock levels. Supply chain disruption is also a concern, particularly within the heparin supply chain, which experiences periodic pressures, page 13. Furthermore, the global trade slowdown mentioned on page 6 could exacerbate these issues by impacting external demand and potentially leading to supply chain disruptions. That concludes the financial summary for Shenzhen Hepalink Pharmaceutical Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.